This lecture is presented by John Moffat of Open Tuition. For other free lectures, visit opentuition.com.
We're working through the June 2015 paper F9 exam. We're in section B and we're up to question 4. So let's read the requirements. Part A. Evaluate the effect on the wealth of the shareholders of Grenup of using the net rights issue funds to redeem the loan notes. And B. Discuss whether Grenup might achieve its optimal capital structure following the rights issue. So part A, 8 marks, just over half marks. That's the calculations. But it's going to be rather important, as always, that you've done something for part B if you want to be certain of getting your 50% pass marks. Let's have a quick look at the information. They're planning to raise 11.2 million through a rights issue. The new shares will be offered at a 20% discount to the current share price of Grenup, which is $3.50. The rights issue will be on a 1-for-5 basis, and the issue costs will be paid out of the cash raised. The capital structure is as follows. Well, we'll look at that when we need it. The net cash raised by the rights issue will be used to redeem part of the loan note issue. Each loan note has a nominal value of 100 and an ex-interest value of 104, and a clause in the contract allows them to redeem the loan notes at a 5% premium to market price at any time prior to redemption date. The PE ratio is not expected to be affected by the redemption of the loan notes. The earnings per share is currently 42 cents, and the total earnings are 8.4 million. They pay corporation tax of 30%. Well, how are we going to approach it? It says evaluate the effect on the wealth of using the rights issue funds to redeem the loan notes. What we're going to have to do, we're going to have to work out, first of all, the theoretical ex-rights price. And that's fairly standard workings, we'll check in a minute. But the theoretical price is what the new share price would be, ignoring what they're going to do with the money they've raised. In practice, of course, you normally expect the share price to end up being higher than the theoretical price because, hopefully, they'll have done something good with the money they've raised. And what are they doing? They're raising money. If they did nothing with it, it'd be the theoretical share price. But they're using it to repay some of these loan notes. And so to see the effect of using the money to redeem the loan notes, we need to calculate what will the share price actually end up being? What would it have been on the theoretical price if they'd done nothing with the money? And the difference is the effect it'll have had on the wealth, the gain or the loss. So let's have a go. And let's first of all look at the theoretical price. The theoretical ex-rights price. What are we told? We know that the current share price is $3.50. And we know the rights issue will be offered at a 20% discount, and it'll be a 1-for-5 basis. So to get the TERP, let's suppose somebody currently, you can set your workings out any way. If you've learnt rules, it doesn't matter, the final answer's the same. But if somebody currently owns 5 shares, the current wealth, 5 shares at a current price of $3.50 is $17.50. The rights issue is 1-for-5, so they're entitled to buy 1 new share. The cost of that new share, well, it's at a 20% discount to the $3.50, So 80% of $3.50 is what? $2.80. However, a slight trick here in that issue costs will be paid out of that cash raised. So although the value is going up by the $2.80 they pay in, it's going down by the issue costs. And how much will it go down by? Well, the issue costs in total they're 280,000. How many new shares are issued? It's 1 for 5. Currently, how many shares have they got? If you look at the capital structure, the nominal value is 10 million. They're 50-cent shares, so there must be 20 million shares in issue. So for every a rights issue share, there's 4 million rights issue. For every share, the issue costs 280,000 divided by 4 million is 7 pence. And so the actual increase in the value for this shareholder, the one extra share, will be $2.73. And so they'd end up with a total of 6 shares with theoretically a total value of 19.23, I think, giving an ex-rights price 20.23 for 6 shares, an ex-rights price of $3.37. That's a bit of rounding there. I'm doing it to the nearest cent. But appreciate what that figure is. That's what the new share price should be per share, ignoring whatever they may be doing with the money that's been raised. What we need now to look at, to discuss the effect of using it the way we're doing, is let's now work out what share price we would expect given that they're repaying the loan notes. And how are we going to do that? It's going to be a separate approach completely, because what we're going to have to use, it tells us below the capital structure information, it tells us that we're using it to redeem part of the loan notes. And it says the PE ratio is not expected to be affected by the redemption of the loan notes. Now, what is the PE ratio? The PE ratio is the market value divided by the earnings per share. So what's the current PE ratio? Well, currently, the market value, the current share price is $3.50. The earnings per share, well, I'm sure I saw it somewhere. Yes, the earnings per share at the very bottom of the question are 42 cents per share. And therefore, the current P ratio 8.33. And so what we're going to have to do is we're going to work out, assuming the P ratio stays the same at 8.33, let's work out what the new earnings will be if they repay these loan notes, and therefore what the new market value will be. So let's work out the new total earnings. Now, do it in total initially. We know what the current earnings are. 8.4 million. And that makes sense, it checks. Remember, we'd already said there are 20 million shares. The earnings per share are 42 cents. So fine, it is 8.4 million. Why should they change in future? Well, if we repay loan notes, we'll be paying less interest. And if we're paying less interest, the earnings will go up. So we need to work out how much interest we'll save on the redemption. Well, I'll do separate workings for this and then come back and tidy it up. How much interest will we save? Well, it depends how much we redeem, of course. So first of all, how much cash do we have? The net cash is going to be used to repay these loan notes. So the net cash, we're going to raise 11.2 million, of which 280,000 are issue costs. So we're actually going to raise, we're actually going to have available for repayment 10.92 million cash raised. How much interest will we save? Well, we're going to redeem the loan notes at a 5% premium to the market price. And so we're going to redeem these loan notes or repay at the current market value of 100 nominal is 104. It's going to be at a 5% premium. So add on 5%, multiply by 1.05. The redemption price is going to be 104 times 1.05 is 109.2. So we're going to have to pay 109.2 for every 100 nominal. So the nominal amount received, redeemed rather, remember we're going to be paying out 10.92 million, and we're going to have to pay 109 for every 100 nominal. So 100 over 109.2, which is rather nice, it's 10 million. So that's the nominal amount of loan notes that we redeem. And how much interest will we save? Well, the interest on they're 8% loan notes, so it's 8% on nominal. So the interest saved, 8% of 10 million is 0.8 million. That's how much interest we'll save per annum. Well, now I can go back to the schedule I'd started. Currently, earnings are 8.4 million. Because we're paying out less interest, the earnings will go up by the 800,000 a year that we save. But, of course, the pre-tax earnings will go up by 800. But as a result, there'll be more tax payable. So the extra tax on the interest saved. The tax rate, very end of the question, is 30%, is 240,000. And so the new earnings will be 8.4 million. Oh dear, what am I doing? I hope I'm right. I get 8,960. 8.96 million. And therefore, the new earnings per share Total earnings 8.96 million. How many shares are in issue? I think we worked out earlier, but anyway, at the moment, nominal value 10 million, 50-cent shares. At the moment, there are 20 million in issue, but we've had the rights issue, remember, of 1 for 5. So an extra 4 million. It gives a new earnings per share 8.96 divided by 24 of 0.3733. And therefore, I haven't left quite enough space. But if that's the earnings per share, and if the P ratio isn't changing, the new market value per share, the P ratio 8.33 times the earnings per share, I get a new market value per share of 3.11 to the nearest cent. And now we've got it, you see, going back to how I started. The way they're using the rights issue money and repaying the loan notes and so on, the share price ends up at $3.11. In theory, the rights issue, ignoring what they did with the money, would have given a share price of $3.37. And as said at the beginning, that although usually you expect the actual share price to be higher than the TERP, that to be the gain, because hopefully they use the money well, either invest in a good project or save lots of interest. And it's not always the case, and here it hasn't. But here, it should have been at 3.37 in a perfect world. It went down to 3.11. So they've actually made a loss of, I think 3.37 was it? I'm sorry. Yeah, 3.37 minus 3.11. They've made a loss of 26 cents per share. And there we are. It said evaluate the effect on the wealth. And we've done it. They've lost 26 cents a share. Or you could have done it in total and got the total loss, but that's, I think, the way you wanted it. That's part A, and quite neat because, you know, two separate things there, both of which have been tested lots of times. But working out theoretical X rights price, which is an exercise all on its own, and separately using a PE valuation. So two separate bits. The mark's available for each bit, you know, but then it's rather neat the way he's put them together. Anyway, part B. As always, I'm not going to write all this down, but it says discuss whether we might achieve the optimal capital structure following the rights issue. Whenever it's asked anything like that, and it is reasonably common, it's only discussion, but he is expecting discussion of the various theories of gearing. And for me to repeat it all here would be absolutely ridiculous. It's in the notes, we've got the lectures on it, there's the examiner's own answer to read. But you've got the traditional view where as you change capital structure, the weighted average cost of capital will change and there will be a minimum, therefore an optimal level of gearing somewhere. You've got the Modigliani and Miller without tax view. If there's no tax, the weighted average should stay constant and there'd be no optimum. But you've got the Modigliani and Miller with tax view, that the higher the gearing, the lower the weighted average because of the tax benefit associated with debt. except at very, very high levels of gearing. And so then you would want to be as highly geared as possible. There is tax here, but a problem with Degani and Miller is the assumptions they make. Subject to the assumptions, they should be as highly geared as possible. In real life, perhaps there is some opt-in. Anyway, read the answer on your own. I'm not going to say any more there.